Okay, good evening once again. Let us start with the questions of AS4 which were pending. Now tell me one thing, yesterday we completed question number 1, 2, 3, 4 and 10, right? Only the 5 questions have been completed, right? Okay. So we will now start with question number 5. We'll start with question number 5 now. What is question number 5 saying? While preparing its final accounts for the year ended 31st March 2017, a company made a provision for bad debts at the rate of 5% of its total trade receivables. That is, 5% of the total debtors is provided as doubtful debts, that is RDD. We have created RDD. In the last week of February 2017, a trade receivable for rupees 2 lakh had suffered heavy loss due to an earthquake. The loss was not covered by an insurance policy. Okay. In April 2007, the trade receivable has become bankrupt. Can the company provide for the full loss arising out of insolvency of the trade receivable in the final accounts for the year ended 31st March 2017? So what do you think? Is this an adjusting event or a non-adjusting event? Because if it is adjusting event, then you have to provide for full 2 lakh as a loss in the books of accounts. That is, you have to create a full 2 lakhs of provision. But if it is a non-adjusting event, then you just have to give a disclosure. So what do you think? Whether it is an adjusting or a non-adjusting event? Now, yesterday only I told you, if the question is silent, whether the accounts have been approved by the board of directors or not, always assume that it is not yet approved. Because then if it is approved, then no need of discussing the question only. Because then if it is approved, you cannot do any adjustments. So technically, this is an adjusting event. Why? Because in the month of February, the loss had taken place. So technically, as on 31st March, the situation or condition is existing that the debtor may turn insolvent. And in the month of April, the event took place that he has been declared insolvent. So technically, it is an adjusting event, right? And we have to record the full loss of 2 lakh rupees in the books of accounts. And sir, the solution will be very much similar to the earlier questions that we have solved. Right? So what we have to do is the first paragraph will be nothing but the definition of the adjusting event. We'll be giving the definition of adjusting event. Solution to answer number 5. See, as per AS4, assets and liabilities should be adjusted for events occurring after the balance sheet date that provide additional evidence to assess the estimation of amounts relating to the condition existing at the balance sheet date. So first paragraph is nothing but the definition, or they have just defined the adjusting event. Now comes the given situation. So full provision for bad debts amounting to rupees 2 lakh should be made to cover the loss arising for bad debts amounting to rupees 2 lakhs. Oh, sorry, I read the statement again. I'll read it again. So full provision for bad debts amounting to rupees 2 lakh should be made to cover the loss arising due to insolvency in the final accounts for the year ended 31st March 2017. It is because earthquake took place before the balance sheet date. If this earthquake had taken place after the balance sheet date, then obviously it would have become a non-adjusting event, and we just have to give a disclosure in the director's report. Right? A very simple one. I think yesterday when we did some questions, this type of question had already arisen. Right? It's a jackpot 5-mark question in exam, if it comes. We'll go for the next question now. We'll first start with question number 7. 6th, I'll be doing at the end because this is a very, very different question. So we'll start with the 7th, 8th, and 9th first, and then we'll go for the 6th question. Yes, Mr. Dikshit.
Sir, please open the answer of fifth question, sir. I will take the screenshot.
Sir, you don't have the soft copy of the notes?
No, sir, I didn't getting, sir.
Okay. Do one thing, 5th and 6th, take it together.
Yes, sir.
8, 10,
Yeah,
6,
sure,
both
sir.
take it together.
Yes, sir, I taken. Thank you.
Let us discuss the seventh question. What it says: you are an accountant preparing accounts of A Limited as on 31st March 2011. After year end, the following events have taken place in April. So technically, event number 1, event number 2, both have taken place in the month of April, and obviously the accounts are not yet approved. Because if the question is silent, we will always see that the accounts are not yet approved. So technically, we have to decide if it is adjusting, make adjust in assets and liabilities. If it is not adjusting, give a disclosure in the director's report. First point: a fire broke out in the premises, damaging uninsured stock worth rupees 10 lakhs. Salvage value is 2 lakh rupees. Sir, salvage value is nothing but the scrap value that you are going to get for the remaining damaged material that is left in your godown. So salvage value is nothing but very much similar to scrap value only. Right? Now, can I say the first case is purely a non-adjusting event? Because the condition of the fire is not existing on the balance sheet date. So technically, the loss of rupees 8 lakhs, obviously it is material to the enterprise. 8 lakhs is a big amount, sir. So it is technically material to the enterprise, but sir, it is a non-adjusting event. So only a disclosure in the director's report should be more than sufficient. Correct? Now somebody will ask, sir, whether it is affecting your solvency. Sir, if you are having stock worth 10 lakh in your godown, right? So technically you are a big trader. You might be selling 80-90 lakh worth of goods every year. That is why you're having roughly 10 lakh of goods in your godown. So technically, this 10 lakh is a very, or 8 lakh is a very small amount, which is definitely not going to affect your going concern. So we will not answer from that angle. So only one angle will be answered, that is, it is not affecting any of your solvency part. So it is purely a non-adjusting event. Point number 2. A suit against the company's advertisement was filed by a party claiming damages worth rupees 20 lakhs. Now, sir, please understand, a suit against the company's advertisement. Suit means court case was filed. And sir, can I say court cases are nothing but contingencies? Court cases are contingencies. And technically, if he is claiming from you a damage, so it can be a contingent loss for you. So on the basis of probability of the loss, you will decide whether you have to record this or ignore this, or you have to create a provision. Because 3 things I gave: if the loss is remote, ignore. If the loss is reasonably possible, create, means record it in the notes to accounts. And if the loss is probable loss, then you will be creating a provision as per AS 29. Right? These are the three points which we discussed yesterday with respect to contingencies. But sir, here can I say probability is not given, like what is the chances of occurrence of the loss? So I will simply answer that you have to show this as a contingent liability in the books of accounts. Means I will not take this remote and I will not take this as probable. I will consider this as reasonably possible. And just give a disclosure in the notes to account with respect to this contingent liability of this 20 lakh rupees. Right? So this is not considered as an adjusting or a non-adjusting event. This is a contingency. And contingency will be shown directly in the notes to accounts, not in the director's report, in the notes to accounts. Describe how will you deal. So I've already told you the answers for this. Now, a small change I had made in the solution within the morning batch. So I will also tell you to do the same. Now, actually, when we read the answer of the first part, now see, from here it is the second part. From here to here, it is the second part. That is with respect to the suit filed, second part of the question. So that answer is absolutely fine. But the first part answer that they have given is a bit complex. Let us read it first, and then I will tell you what changes you do it in it. Now, what they say: events occurring after the balance sheet date that represents material changes and commitments affecting the financial position of the enterprise must be disclosed according to AS4. The key point here is whether the impact of the loss is material or not. As the loss has arisen from non-insurance, the event becomes very material, not merely on account of the current loss, but the future vulnerability. Hence, fire accident and loss thereof must be disclosed, as also the fact that the stocks of the company are uninsured with a value of the future risk, if possible. Now, sir, if you read this answer, this is a bit like technically confusing. So let us have a simple answer for this. We'll make the answer very simple. Now, can I say this event we have considered as a non-adjusting event? Right. So what we'll do is we will start the answer by defining non-adjusting event. Right. Now people will ask, sir, how will I define non-adjusting? Now, can I say in the earlier question, you are already been provided with the definition of adjusting event. So small changes in the definition of adjusting will make it non-adjusting. What change you have to make, sir? See, assets and liabilities should be adjusted for events occurring after the balance sheet date that provide, or else I'll do one thing. I'll dictate to you people the definition of non-adjusting events. Right. So what you can do is for question number 7, part 1, first part of the question, what you have to do is write definition of non-adjusting event and then explain the given situation. No need to write all these points. Right. You can just give the definition of non-adjusting event and then explain the given situation, that the fire took place in April and there is a loss of 8 lakhs to the enterprise, which is material. But since this is a non-adjusting event, no adjustments will be done in assets or liabilities. Only a disclosure in the director's report will be given. So do one thing, I'll dictate you the answer itself. Please copy down. Please copy down, everybody. I'm giving you a separate solution itself for the first part of question number 7. Please write down. As per AS4, as per AS4, events occurring after the balance sheet date, events occurring after the balance sheet date which do not relate which do not relate to any condition, which do not relate to any condition or situation, which do not relate to any condition or situation existing on the balance sheet date or no such condition or situation exists, or no such condition or situation exists, such events are non-adjusting events. Such events are non-adjusting events. Such events are non-adjusting events. Full stop. Full stop. Next line. In this case, fire broke out in April. In this case, fire broke out in April 2011. Fire broke out in April 2011, damaging goods worth rupees 10 lakhs, damaging uninsured stock. Please write. damaging uninsured stock worth rupees 10 lakhs, comma, is a non-adjusting event, as no condition existed of fire, as no condition existed of fire on the balance sheet date. Full stop. Hence, only a disclosure of this loss. Hence, only a disclosure of this loss as only the disclosure of this loss has to be given in the director's report, as the loss amount is material. As the loss amount is material. Full stop. Right? Now that will be the first part of the solution. The second part, you can take it as it is from the solution which is printed, which is correct, no problem. What it says, suit filed against the company being a contingent liability must be disclosed with the nature of the contingency, an estimate of the financial effect. Estimate of the financial effect means in terms of what is the loss that you can bear, but obviously you need not write any amount. That is called as, that is the meaning of estimate of financial effect, means what can be the damage that can go out from your pocket, and uncertainties which may affect the future outcome must be disclosed as per AS4. So means you have to disclose the contingent liability in the notes to accounts. If possible, what will be the financial impact and what is the chances of the happening of the uncertainty. That is what you have to disclose in the notes to accounts. So here, since we are putting it in the notes to accounts, we say that it is reasonably possible. And damages they are claiming were 20 lakh rupees. But as the court proceedings go on, the damages can come down also. Because you may ask somebody to pay a damage of 50 lakhs, but are you going to pay that full 50 lakh? No. Obviously, in the court of law, discussions will be made, and there is a chance that the damage may be less than 50 lakhs also. So this same solution you can write for the second part. Right? So let's go for the next. I think somebody had to take the screenshot. Na? Second part only screenshot. Please take the screenshot of seventh answer. If anybody is not having the soft copy of the notes, please take the screenshot. Fine. Let us go ahead now. We go for the 8th question. A company entered into an agreement. The second part is not adjusting event. Second part is a contingency. When did I say second part is an adjusting event? Second part is just a contingency, and contingencies have to be recorded in the notes to accounts. So no adjustment is required in the books of accounts. Yes, Vansh, you can unmute. Vansh, you are not audible. Am I audible? Am I audible? You are not audible, sir. Once you are not audible. Log out and log in once again, sir.
Hello?
Yes, Aditya.
Yes, sir. Sir, if I'm correct, yesterday you told that as the contingencies that we record as per AS4 only relate to those of bad debts, and other contingencies are disclosed as per some other AS, like AS29, right? If I'm correct.
Yes, yes.
Yeah, so but this one's not related to.
No, on this contingency, we will answer as per AS29 and not as per AS4.
So it's, but in the answer it's written as per AS4, right? So
No. That is the disclosure part.
yeah, so I'm confused, sir. Is the disclosure as per AS29 or AS4, or what relates to AS29?
See, what they have said over here is you have to disclose the financial impact and the uncertainties which may affect the future outcomes must be disclosed as per para 16 of AS4. Now, technically, the disclosure requirements of a contingency, whether it is as per AS4 or whether it is as per AS29, it is one and the same. Because
Okay.
end of the day, contingency remains the same. The only difference is what? Contingencies with respect to bad debts, that is doubtful debts, are covered by AS4.
Okay.
And rest all contingencies are covered by AS29. But sir, end of the day, yesterday also I told, if you remember, a contingency is a contingency only.
Correct.
So the definition, the disclosure requirements all are same. So that is why more briefly we talk in AS29 rather talking in AS4. So in AS4, we just speak about the definition of contingencies.
Okay.
And even the probability of outcomes that I told you, probable loss, reasonably possible. The same point will again be repeated in AS29 also.
Okay. So, but sir, specifically the disclosure part, is it also there in both the AS or only in AS4?
No, sir. This is a common disclosure. Now, whenever you are recording a contingent liability in the notes to accounts, even in AS29, you will see the same point. An estimate of the financial effect and uncertainties which may affect the future outcomes must be disclosed. This common statement you will find.
All right.
Because see, when you record a contingent liability in the notes to accounts, you should first write the nature of the liability. That is first point. Second, what is the expected loss? That is nothing but your estimate of financial effect.
Financial effect, correct.
And uncertainties which may affect the future outcome. Uncertainties means what is the probability of outcome.
Probability of the occurrence, yes.
That you have to disclose. So whether it is as per AS4 or AS29, the statement is going to remain the same.
All right, sir. So, is it fine if we don't mention AS4 in this last sentence? We just write the requirements.
No problem. You can just put a full stop over here also.
All right, sir. Understood. Thank you so much.
You can put a full stop here.
Yes, sir. All right. Thank you.
Yes, Vansh. Unmute.
Sir, I just.
Oh, sorry. You're again be muted. Wait. Yeah, please.
Yes, sir. I just joined. Am I audible now, sir?
Sir, do one thing. Switch off your camera when you are speaking. I think you have a good net connection. Please speak.
Am I audible now, sir?
Yeah, you're audible.
Am I audible?
Yes.
So I'm a little bit confused right now, sir. Now, actually, AS4 says that only contingent losses with respect to doubtful debts records in under AS4. And this second part of the question number 7 says that the suit you're saying is contingency, but it's not related to doubtful debts, sir. So how come it comes under AS4?
See, but I'll tell you one thing. Question can be raised. A question can be raised. So here they are actually trying to ask you that whether you are going to consider this as an adjusting event or not. This is basically a googly question. Please try to understand. Many of the students fall prey for this question. Shouldn't answer this in the form of adjusting or a non-adjusting event. But technically, sir, this is not an adjusting or a non-adjusting. This is rather a contingency.
Yes, sir.
So a question based on contingency can be asked. See, they are not telling you to answer as per AS4 only. They have actually asked a googly question. First one is where it is, yeah, question number 7. Yeah, first one is a non-existing event, and second one, in the flow of the question, you either answer it as an existing or a non-existing event. But sir, you have to understand, whenever it is a suit against the company, that is a court case is filed, it is a contingency only. And contingencies.
So sir, is it necessary to
please.
mention AS4?
Even if you don't, that is no problem. Because see, as I told you, the disclosure requirement that you have in AS4 and the disclosure requirement that you have in AS29 for contingent liabilities is one and the same.
Yes, sir.
Right? The only end of the day, a contingency is going to remain a contingency only. The definition,
yes, sir,
how to derive the final outcome of a contingency, whether you are doing it as per AS4 or you are doing it as per AS29, it's remain the same. But the only difference is what? Since we have separately made an AS29, entire part of contingencies are now shifted to AS29. And I'll tell you one thing, in majority of the classes, they don't even teach contingency part in AS4. They directly start AS4 with events occurring after the balance sheet date. I just kept a base of contingency for starting AS4. Because in detail, with respect to contingencies, we again have AS29. But when I start AS29, you already have a base of contingencies. So don't get confused over here. Means you cannot conclude in your solution that, sir, this is a legal case file, this is not related to doubtful debt, so AS4 is not applicable. Question is saying to answer as per AS4. Has the question told you to answer as per AS4? No, question says disclose how will you deal with the accounts. So
so if the question asks how to deal with the account.
Yes, please go on.
So sir, if the question asks how to deal with the account, we have to take from the non-existing and existing point of view, right, sir?
Means technically the question is based on adjusting and non-adjusting only. But this is a googly point that this is not an adjusting or a non-adjusting. This is actually a contingency. So student, what happens when he reads the first one, second one also he answers in the same flow that it is non-adjusting. Because it has taken place in April and no condition is existing. Or some people think in that way, sir, advertisement was given by the company before itself. So obviously the advertisement might have been seen by the public on the balance sheet date also. So some people will answer that, sir, it is an existing event. Because the condition of advertisement is existing on the balance sheet date, which is very much true. And the additional evidence is the court case file. But sir, is it a conclusive evidence? Is the court case giving you a conclusive evidence that you have to pay a 20 lakh rupees damage? No, sir. It is a contingency which has been started now. And as per the definition of contingency, first point was what? There should be a condition or situation existing on the balance sheet date. And the condition or situation is existing because your advertisement is already out. Right? So technically, this is a pure contingency which has to be recorded in the notes to accounts. Let us go for question number 8. Question number 8. A company entered into an agreement to sell its immovable property to another company for 35 lakh rupees. So already they have entered into the agreement. The property was shown in the balance sheet at only 7 lakh rupees. The agreement to sell was concluded on 15th February 2011. Agreement has already been entered by both the parties, right? And the sale deed was registered on 30th of April. So they made the sale deed first, but due to some reasons, they might have not registered the deed, but they got the registration done after the balance sheet date, that is on 30th of April. You are required to state with reason how this event would be dealt within the financial statements of the company as on 31st March. Will this be treated as an adjusting or a non-adjusting event? What is your logic? Sale deed was entered, but registration was done after 31st of March. One answer I got adjusting. I'm getting 3-4 answers I got adjusting. And technically, yes, sir, this is an adjusting event. Right? I can also use the logic of substance over form over here. Go for the substance of the transaction, and the substance says that you have already sold it. Only the legal title is yet to be transferred. So technically, as on the balance sheet date, this sale has to be recorded in the books of accounts, and you can also record the profit of 28 lakh rupees in your P&L account. 28 lakh as in you sold for 35 lakhs, book value is 7 lakhs. So 28 lakh is the profit. So sir, same first paragraph will be the definition of adjusting events, and then followed by given situation. So what is the solution? Let's see. As per AS4, assets and liabilities should be adjusted for events occurring after the balance sheet date that provide additional evidence to assess the estimation of amounts relating to conditions existing at the balance sheet date. This is the first paragraph, provision paragraph, that is definition of adjusting event. In the given case, sale of immovable property was carried out before the closure of the books. This is clearly an event occurring after the balance sheet date, but the agreement to sell was effected on 15th February. That is before the balance sheet date. Registration of the sale deed was made on 30th of April. Simply provides, the registration on 30th April simply provides additional information relating to the condition existing at the balance sheet date. Therefore, the adjustment to asset for sale of immovable property is necessary in the financial statements for the year ended 31st March 2011. And you can also add up this point, comma, and the profit on sale rupees 28 lakhs should be recognized in PL account. This is an additional statement. If you want, you can write. Right? Simple one, simple question. Hope such questions come in exam where you can fetch 5 out of 5. Right? Let's go for the next one. So somebody has to take the screenshot. Please take the screenshot. First, take the screenshot for 8th one. Then I'm changing the screen. 7th. Yes, it is an exceptional ordinary item. In the P&L account, 28 lakh will be shown as an exceptional ordinary item because it's a profit on sale of the fixed asset. I think the student K139187, I think Soumya. Beta, if you are traveling in a bus, you can switch off your camera because you will have a lot of network issues. No problem, you can switch off the cameras. I will not remove you from the lecture. I think it is Soumya, na? 139187. Yeah, you can switch off your camera because you are traveling. Should we also mention substance or form? Not required, sir. Not required. Don't mention substance or form. I just explained you with the help of that concept, but no need to write substance or form in the answer. No, not required. Purely answer it from adjusting event point of view. That would be more than sufficient. We go for question number 9. Now, sir, the question number 9, part 1 is same as question number 8. It is same to same question number 8 only. So I'm not discussing this because it is same to same question number 8 only. Only the amounts are different. I'm going for the second part. What they say, state with reason how the following events would be dealt with in the financial statements of Pradeep Limited for the year ending 31st March 2013. So the first event is with respect to the question number 8 only. So I'm not discussing this. Let us go for the second event. The negotiation with another company for acquisition of its business was started on 2nd February 2013. Pradeep Limited invested 40 lakh rupees on 12th April 2013. Can I say we saw such an example yesterday? Example number 1 of non-adjusting events, right? Major business combinations, amalgamations, mergers, right? So can I say this is a merger going on? I would say this is an amalgam. We are acquiring the business. So basically, this is amalgamation going on over here. So technically, all amalgamations, even the deal was started on February. So the condition is existing on the balance sheet date. But sir, the point is it is still a non-adjusting event. Reason, on 31st March, no adjustments are required. Adjustments will be required after 12th April when you buy out the business. So you will buy his assets, you will settle the liabilities. So accordingly, the assets and liabilities will be adjusted on or after 12th April. That is in the next financial year. So in this financial year, only a disclosure in the director's report will be more than sufficient because it's a purely non-adjusting event. If you remember, I told yesterday only that questions were asked on these examples. This was an examination question. Now, even I have made a change in solution to the 9th second part. See, I've cancelled this part. So what you have to write as per AS4, give the definition of non-adjusting events, and then you can copy the given situation. What it says, accordingly, the acquisition of another company is an event occurring after the balance sheet date. However, no adjustment to assets and liabilities required, as the event does not affect the determination and the condition of the amount stated in the financial statements for the year ended 31st March 2013. Because this event is not going to make any changes in any of the figures of the balance sheet. Hence, it is a non-adjusting event and only a disclosure will be more than enough. Right? So we can just add up one more line over here. So I'll just add up one more line over here. Full stop. A disclosure of this event should be made in the director's report. That's it. So what you will do is, for the first part of that is the first paragraph, please write the definition of non-adjusting event, which I gave you, I think, for question number 7, I already gave you in writing. So what you have to do is, you have to write the definition and then copy the same second paragraph as it is. Right? This is question number 9, 3. Question number 9, second part. Right? I hope you have taken the screenshot also, because for some people the soft copy is not there. So now we go for the last and the final question of the topic, and this is something interesting. This question is actually interesting, and this will come in exam, and this is a module question also. So let us understand question number 6. What it says, comment on the following. So you have to comment on this situation. What is the situation? Let us understand. A company follows April to March as its financial year. Okay. The company recognizes checks dated 31st March or before received from customers after balance sheet date, but before the approval of financial statements, by debiting checks in hand account and crediting the debtors. Now, sir, what is happening? These people have some closing debtors as on 31st March, right? And these debtors are issuing checks to the company in the month of April, that is next year. But the dates put on the check are either 31st March or before 31st March. Means they can put 10th March, 15 March, 20 March or 31st March as the case may be. So what the company is doing, since they collected the checks in April, but dated it is March, so they are accounting all these checks in the month of March only. By debiting check in hand account and crediting the debtors, means showing that the amount is collected from the debtors. So they credit the debtors and they are cancelling of the debtors, and they are showing check in hand. And they are showing this check in hand as a cash and cash equivalent. The checks in hand is shown in the balance sheet as an item of cash and cash equivalents. All check in hands are presented to the bank in the month of April and are also realized in the same month in the normal course after they are deposited in the bank. Means whatever checks they collected in April, they accounted that in the month of March, correct? And they deposited the check in April into the bank and also got it cleared. So whatever the company did is correct or not. Means technically I would say that company has considered this as an adjusting event. Company has considered this as an adjusting event because checks are received in April. So they adjusted all the checks in March only. March means they adjusted in the current balance sheet. So technically they have considered this as an adjusting event. What do you feel? What is your opinion? Is the company correct or not? What is your opinion? Anybody would like to answer? They can just use the raise hand option and they can give their answers accordingly. I'm getting an answer from Mohit. There's whatever the company did is correct. Okay. The direct entry students can play a major role for answering this because they're already doing some audit work and they might have come across such situation in their day-to-day routine also. Niranjana says it is correct. Okay. So it is an adjusting event. Okay. Ritika also says it is an adjusting event. Okay. Jyotika says yes, sir, the company is right. Okay. Means majority of them saying yes, sir, it is correct. Okay. So if so many people are saying it is correct, so it may be correct only. But sir, always remember one thing: we are doing CA, right? And in CA, one thing you remember: when majority people give one common answer and 2 or 3 people give an uncommon answer, technically those 2 or 3 people are only correct. Major people giving the same answer are always wrong because that is the common thinking that is done by everybody. But in CA examinations, common thinking is not required. Something uncommon has to be done. And generally, the uncommon answers are correct. But now I'm not telling that whatever you said is wrong. No, I'm just giving a general perspective. Now, one answer I'm getting by Ramakrishna, it is non-adjusting event. Sir, Ramakrishna, I'm asking you to unmute. Sir, why do you think it is non-adjusting?
Sir, I thought that the company has not received its checks before 31st March, sir. It has been received after 31st March, so it should be a non-adjusting event, sir. They are already, the customers are already in the debtors account, sir. They are only transferring it from debtors to checks, sir. Checks are not received by the company before 31st March. So I thought that it would be a non-adjusting event.
Okay, so but sir, checks are dated 31st March, na, sir. So checks are dated 31st March means, sir, who is going to come and see when did you receive it? Date on the check is more important, na, sir. So date is 31st March or before. So you can account it in the month of March itself, na, sir. What is the problem then? Who is going to come and check when did you receive the check? Yes or no?
Yes, sir.
Ramakrishna is confused now. Anybody else would like to answer this? Anybody else? Anybody else would try for this? Whether it is adjusting or non-adjusting event. Fine, then I'll do the honor. Now the people, those who told adjusting event and the people, those who told non-adjusting event, sir, both the answers are not correct. Huh? This is not even adjusting and not even non-adjusting. Then what it is? Sir, it is actually an insignificant event. If you remember yesterday's lecture, events were divided into 2 parts: significant, insignificant. Insignificant were ignored, and significant had 2 more bifurcations: adjusting, non-adjusting. Now I'll tell you why it is insignificant. Please understand, sir. I have 3 logics behind this. Please try and understand all my 3 logics. Sir, point number 1. Is the check collection affecting your financial position? No, because on one hand, you are showing the check is collected, but on the other hand, you are setting off your debtors. So technically, the value of your current assets are going to remain the same. So point number one, this is having no financial impact on you. Point number two, where is the condition existing on the balance sheet date? So technically no condition exists on the balance sheet date, because if you are having the debtor, it is implied that you are going to get a check. So getting a check does not make that it is an event. Receiving a check from the debtor is not an event at all. And point number three, the check is received in month of April. So generally the checks are accounted when they are received, because the check becomes your asset when you control that checks. And technically, as on 31st March, you are not in possession of the checks. So technically, you don't have a control on those checks, hence they are not your assets. See, as per the accounting framework, assets are those on which you have your control. You control the assets. As on 31st March, did you have those checks in your hand? No. So is it your asset? No, because you cannot control those checks. So technically, they are not your assets, right? Technically, they are not your assets. Second point, this is completely insignificant, because even if the check on hand it is not going to affect, or it will not have any financial impact on me. So technically, it is insignificant for me. So not even a disclosure is required in the director's report, and adjustment is completely incorrect. So whatever the company did over here, I will say it is completely incorrect. Because no condition exists, the checks are not in my control, it is not my asset, so how can I record it? And the check should be accounted in the month of April itself, that is in the next financial year, not in the current financial year. So let's check the solution once, and we'll further discuss the points over there. Now what it says, even if the checks bear the date 31st March or before, the check received after 31st March do not represent any condition existing on 31st March. See, there are no conditions existing, because technically, if you have a debtor, means the debtor is obligated to give you a check. So collecting a check cannot be related to any condition existing. Now some people will say, sir, we have a debtor outstanding as on 31st March. So debtor outstanding is a condition existing. No. If you have a debtor, means it is implied he will pay you. So there is no condition as such. It is not, see, condition means what? Condition means it is financially impacting you. And technically, sir, this is not having any financial impact. Thus, the collection of checks after the balance sheet date is not an adjusting event. It is not an adjusting event for sure. Recognition of checks in hand is therefore not consistent with the requirements of AS4. Moreover, the collection of checks after balance sheet date does not represent any material change or commitments affecting financial position of the enterprise. And so no disclosure of such collection in the director's report is necessary. Means, sir, even if you collect the checks in the month of April, is it having a financial impact on you? Technically, no, because on one hand you have collected the checks, and other hand your debtors will go. So your current assets and everything are going to be having the same value. So since it is not having any financial impact on you, so it is immaterial. Immaterial means it is insignificant. So not even a disclosure is required. See, if it is not an adjusting, means it should be a non-adjusting event. But sir, to be a non-adjusting event, it should be significant, right? Here it is not significant at all. Hence, no disclosure is also required. I'll just say right over here, not significant. Then it should also be noted that the framework for preparation and presentation of financial statement defines asset as resource controlled by an enterprise as a result of past event from which economic benefits are expected to flow to the enterprise. Since the company acquires the custody of the checks after 31st March, it does not have any control over the checks as on 31st March. And hence, check in hand do not qualify to be recognized as an asset on 31st March. So because of these 2 or 3 reasons, we say that whatever the company did is incorrect. I hope you are understanding this question. It's a very, very nice question. But sir, checks dated 31st March, so somewhat it's related to current balance sheet, right? Isn't it a significant event? No, sir. Please understand one thing. Even if you have received a check, see, if I go into technicality, it is insignificant. Because as per the definition of assets, the check in hand is not my asset. So if it is not my asset, how can I record it? So if I go technically, whatever the answer is given is absolutely correct. There is no second opinion for this. But sir, if I talk about real life, whatever the company did is correct. Because in real life, this is a standard practice that we do. Even if the check is received in April and it is dated in the month of March, we account it in the month of March only. And then we put it in the reconciliation statement. You have done VRS, right? Right? So what we show is, check received but not deposited. Check collected but not yet deposited in the bank. It becomes a reconciliation item. So it is a standard practice in the market. And as I told you, who is going to come and check whether you received the check in April or in the month of March? Right? So this is a common standard practice. But we have to answer not as per the standard market practice, we have to answer as per the relevant accounting standards. So as per the accounting technicalities, it is not my asset. And hence it should not be recorded. But if you are doing articleship, you will come to know that many parties will issue you check in the month of April or May. And the dates will be put of March. And these are all adjustment checks. Adjustment checks means all tax planning checks, basically. Many people do. It's a very common standard market practice. And people will account it in the month of March itself and put it as an item of reconciliation. Right? But this is as per the technical answer. And as per technicalities, the answer is correct. So here we complete. Sir, if at all, if you have received it in the month of March itself, then no problem, sir. If you would have received it in March, you would have deposited the checks also. Why would you wait? We don't even wait for a single day. If I received a check dated today, I will deposit today itself, or maximum by tomorrow. Nobody keeps a check in the cupboard for 1 or 2 months, and after that they will deposit. No. So even if we would have received the checks in the month of March itself, we would have deposited it immediately. Right? So let us go ahead now. All our questions with respect to AS4 have been completed. Right? Even if the check is received on 31st March itself, it will be recorded as an asset because on 31st March, it is your asset. So this answer will not be correct if the checks are received on 31st March. Then we would have said that whatever company did is correct because the checks are in your control as on 31st March.
Sir, I came across the homework questions, sir. Homework section questions. In the question number 4, I have doubt with the subsection 1, sir. It looks like and the question number 6.
Sir, what?
Sir, in the homework section, I have doubt with the homework section in the JKC material, sir. Question number 4.
Sir, this is exactly the opposite question. Checks are in your control because your commission agents, have already collected the check and the agent represents the company. So technically, the checks are in your possession, so it has to be recorded. So this question is a bit different, similar to the question that we just now solved, but the only difference over here is all the checks are sell it product to stockist, and I think the stockist only collect the checks. The checks collected by the marketing personnel of the company from stockist on or before. So if the checks are collected by the marketing personnel represent the company. So it is as good as the company has
okay.
only collected. So whatever it is done in the question will be correct. So such checks in
Okay.
hand will be
So,
shown in the
so in
balance
this
sheet
case,
as cancellation. But in the second question, the check sent by the stockist to courier, that will have the same answer as we did right now.
okay. Okay, sir. Thank you.
Right? 10th question. Yeah, please. 10th. What? Can you show question number 10? Yeah, see question number 10. I'm changing the screen now.